market news now. Emerging market stocks rose for a second day, powered by a rally in Asian shares, amid hopes that the U.S. Federal Reserve could adopt a more modest interest rate hike. Focus will now swing to the Fed's decision on interest rates later on in the day, where the central bank is now seeing lifting its benchmark lending rate by 25 basis points, as opposed to a 50 basis points increase that was expected earlier this month. Meanwhile, the rand rose 0.2% after data showed that the country's headline consumer inflation rose slightly higher than expected to 7% year-on-year in February from 6.9% in January. Meanwhile, short-term insurer Outsurance Group reported an almost threefold jump in half-year profit, helped by strong growth in premiums and favorable operating conditions. To talk to us about this and many other aspects and dynamics playing out in the market, we are joined by Roy Mutuni, who is a portfolio manager at Sanlam Investments. Roy, thank you so much for your time. I mean, we've been dealing with sentiment around the mini banking crisis, as some have described it, and yet at the same time we're trying to decide whether the Fed is going to go 25 basis points or pause. How are you assessing global and local market sentiment at this point?
Look, I think it's improving. It's probably bottomed out, and you can see that from the reaction of the share prices in Asia overnight. I mean, even the UBS share price has come well off the lows that it had hit. It's probably recovered to where it was before all of this began, just showing you that people are a lot more comfortable with the outlook. Remember, the issue here is, can the Fed and can these central banks use their multiple tools to first control inflation, which they've tried without much success so far, and also ensure financial market stability, or rather financial sector stability. And I think with each pronouncement that comes out, the markets seem to be getting more and more comfortable. We'll hear what happens tonight, both with the interest rate decision and with the commentary afterwards, particularly when Chairman Powell makes his comments and speaks out. That's where I think we'll know precisely where we're heading. But I think markets feel comfortable that the Fed and all these central banks are able to use interest rates to continue fighting inflation, and then use other tools to maintain financial sector stability.
So, I mean, what should the Fed be actually doing, given the fact that they've always been telling us that they will constantly, be looking at data, be looking at financial conditions, etc.? What should Jay Powell be doing tonight?
So if you think about it, interest rates have been hiked quite aggressively. Inflation appears to have peaked, but it's not coming down fast enough. So the big tool that has helped us get here has been interest rates. So for sure, at the back of his mind, he'll be saying, we need to hike. But then the financial sector instability has resulted in a tightening of financial conditions, which is another way of saying demand's been taken out, people are a little bit more wary. So effectively what's happened is it's probably replaced a number of interest rate hikes. So I think previously the market was expecting interest rates to peak at 525, 550, give or take. Maybe this instability that we've seen and this tightening of financial conditions has taken away maybe up to 25 basis points or 50 basis points of hikes, which means I think he still needs to hike. He just doesn't need to be as aggressive as before. Remember, the thing is, they've always told us that by hiking interest rates, they're targeting inflation. The primary job is to target inflation. So he can't just stand up and say, no, we're not going to do anything because we're watching. I think that sends a wrong message. It probably is a message that they're more worried than they're letting on. So I think he'll try and tread a fine line between what they do with interest rates and what he says in his comments, to ensure that the message gets across that they're remaining serious about inflation, they understand what's happening with financial markets and the financial sector, and they're trying to control both.
So let's talk about transaction capital and bring things back to South Africa. I mean, the developments, at least over the past week, have been quite interesting, given that share price capitulation that we saw. When you look at the share right now, I mean, it's still trading a little, well, quite lower than it was probably a month ago. Mm-hmm. Do you come in at this point, at this share price, or do you wait and see what happens? What are the concerns here, especially given what we've seen, whether it's the CEO, offloading about 40% of his, holdings? What are the concerns here for you?
I think the important thing is to look at the chronology of events here. Effectively, what they came out and they said was, we've looked at our markets as we were finalizing the outlook for our results, and we've seen a dramatic change in our core market in SA taxis. Basically, that what they thought they could sell into that market, they no longer can, and that strains in that market means that people whom they've advanced loans to buy taxis are less able to service those. And as a result of that, they want to restructure their entire business. Now, one of the things that investors need to keep in mind is when such a warning comes, it's quite clear. If your market is much smaller, it means your outlook for earnings is a lot weaker. It must mean that your projections must come down. But this is a stock that was very highly rated. It was on a 20 multiple on a PE basis. So there was very little margin for error. The market was banking on them continuing to deliver earnings growth like they've delivered in the last 4 or 5 years. But it's quite clear now that the key engine of growth wasn't growing as fast as the market expected. So immediately what happens is a complete reassessment of outlook, and that brings it down to a lower multiple. Now, they've come out with a trading statement that's guiding to normalized earnings, probably falling by about half for the half year and about 20% for the full year. I think it just confirms that initial guidance that they gave, and also confirms the market action that followed the shares. So this is actually perfectly rational. And it is simply a coming down to reality of expectations for earnings growth there. So I think as investors, just keep watching, listen to what management say, look around, see the environment. It's clearly a lot more, it's a clearly more complicated environment for people who own taxis, people who finance taxis, people who use taxis. So the optimism shouldn't be the same as it was 6 months, 12 months ago. Caution definitely needs to be applied, but you can see, I think the share price is finding its level. The market seems to have recalibrated its expectations, and we're probably near fair value now.
Before I let you go, Roy, you've got Bank of America, running the survey with global fund managers, looking at where the pessimism levels are sitting, the worst in 20 years. What's concerning you, top of mind, one thing with just under a minute to go? What's the biggest concern for you?
So it's exactly what you said at the beginning. Financial conditions are tight. And the problem is interest rates have risen incredibly aggressively. So we don't know what's underlying all of this. Something's got to break. Our feeling right now is what's broken is what we're seeing in that mid-tier banking sector in the US. We've seen it in Credit Suisse as well. Right. But I think fund managers are a bit worried about what else there could be, particularly considering that the stock market hasn't sold off as much as the other markets. So there's a feeling that something else could go wrong and the market could sell off quite aggressively. And that's why I think a lot of them are holding onto cash. They're very conservatively positioned, and they're all waiting to see. Remember the problem of the Fed era and stuff like that. That's what I think at the back of everybody's mind is worrying them. So yeah, it's definitely a time when cash is king, and rather sit on your hands than try and be a hero.
On that note, Roy, let's leave it there. Thank you so much for your time. That is Roy Mutuni, who is a portfolio manager at Sanlam Investments. Wrapping it up there with some of the concerns that fund managers are looking at pessimism at its lowest levels in 20 years. And part of it has to do with the financial risk, but also the flight from bank stocks adding to those dynamics. But that is it from me. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.